If you are glued to your screen, if you are watching every tick, and if you are waiting for the market to move just so, you're paying the price of tuition, and the market, let me tell you, is a brutal teacher. You believe you are being diligent. You believe you are exercising necessary supervision, but you are not. You are mistaking activity for opportunity. This is a fatal distinction to fail to make. Every moment you spend watching random fluctuations, every tiny movement up or down, you are eroding your mental capital. That capital is finite. You are wearing down your will. You are increasing the chances that you will panic into a bad position or sell out of a good one prematurely. The biggest mistake, the absolute overwhelming mistake that most speculators make is believing they must always be doing something. They treat the market like a casino table where they must constantly place chips. I tell you the absolute truth, drawn from 40 years of success and failure on this street. Your success will not be measured by the few great trades you make. It will be measured by the overwhelming majority of trades you consciously choose not to make. It is a discipline of inaction. It is the power of selective observation. Subscribe now, like this video, and leave a comment. By doing that, you help more people see this message, and you let me know this work is not in vain. The inherent difficulty in restraining the urge to trade, the very impatience Livermore struggled against, cost him dearly. Those inevitable market penalties are the universal rite of passage for every serious speculator. Edwin Lefebvre, in his 1923 classic Reminiscences of a Stock Operator, granted us the unprecedented opportunity to learn from these exact mistakes. By absorbing the narrative of Larry Livingston, you are not merely reading history, but stepping into a controlled training ground where decades of trial and error are compressed and studied, thereby mitigating your own need to learn through loss. To ensure the profound wisdom captured by Lefebvre remains relevant and accurately translated for the complexities of today's financial instruments, the detailed annotations provided by Max Davidson are crucial. If you are serious about minimizing the cost of your education and maximizing your selective observation, a link to this essential edition is provided in the description below. The curse of constant observation is an epidemic in this business. The market's primary function, as far as I can determine, is to confuse the maximum number of people at the maximum number of times. It is designed to entice you. It is designed to mislead you. If you watch every fluctuation, you are deliberately placing yourself in the crosshairs of this confusion. You are submitting yourself to the emotional whipsaw. The tiny upticks, they give you momentary hope, which you mistake for proof. The momentary drops, they ignite a sharp, sickening fear which forces you to question your entire strategic judgment. Constant observation replaces analysis with reaction. It is the difference between driving a great ocean liner and rowing a small dinghy in a squall. The captain of the liner is focused on the distant horizon and the long-term course correction. The man in the dinghy is terrified by every wave that threatens to swamp him. You must choose which man you are. To be a successful speculator, you must maintain objectivity. You must shield your judgment from the noise of the ticker tape. The tape is a liar if you let it speak too often. It reports emotion more often than it reports underlying reality. I learned this hard lesson myself. In my early days staring at that moving paper, I was addicted to the chatter. I felt I was missing something if I turned my head away. But what I was missing was perspective. I was missing the broad sweep of the general condition. You must only focus on points that confirm the major direction. You must learn to discount, to completely ignore the minor volatility. That volatility is the tax the market imposes on the impatient, the nervous, and the amateur. Do not pay that tax. You must establish the rules of engagement. You must decide what specific event, what concrete price level will signal an opportunity, and then you must wait. You must stand aside, silent and observant, until that signal is fired. If you are always watching, you are always tempted. And temptation is the greatest enemy of sound speculation. Let us speak plainly about activity versus opportunity. This is where the difference between the amateur and the professional speculator is most starkly defined. The amateur believes he must trade every day. He feels a moral obligation to make his capital work constantly. If he sees movement, he feels compelled to participate in that movement. This constant trading is ruinous. It chews up commission fees. It burns away his mental capital. And worst of all, it forces him into low-probability trades. In the long run, the biggest money, the truly sustainable, life-altering fortunes, is made in the trades where you wait weeks, sometimes months, for the true entry point. You wait for the moment where the odds are overwhelmingly in your favor, where the evidence is undeniable. The amateur trades every day. He attempts to scalp small profits from short fluctuations. The professional trades only when the evidence is irrefutable. He seeks the big movement, the one that confirms the general condition is aligning with the particular security. The primary job of a successful speculator is not trading. I emphasize this. It is waiting. Waiting is difficult work. It demands courage and control. It is boring. But you are paid disproportionately for your patience, not for your screen time. The hours you spend in the market watching the prices tick by are mostly wasted hours. They are hours that distract you from the true work. Imagine a skilled hunter. Does the hunter shoot at every rustle in the grass? No. He sits motionless, enduring the boredom until the target is perfectly positioned, visible, and certain. The market is the same. The great opportunity is the clear target. If you fire at shadows, you merely scare off the true quarry. Do not confuse motion with progress. Do not confuse sitting in front of a ticker with engaging in productive labor. True productivity in speculation is defined by minimizing false moves and maximizing the impact of true moves. That requires waiting. That requires stillness. Selective observation is the key to minimizing the noise and maximizing your efficiency. True selective observation means ignoring 95% of the market data presented to you. Most of it is irrelevant noise designed to lure you into a premature or ill-timed decision. Your task is singular. You must identify the line of least resistance, the major dominant trend. Is the market generally moving up or generally moving down? This is the central question. Until that major trend is convincingly broken, or until a major pivot point confirms a definitive reversal, every minor movement, every small counter-trend rally, every momentary sell-off is insignificant noise. You must train your eye to see the architecture of the move, not the mere paint on the surface. If a stock is obviously in a major upward movement, why do you waste time watching it dip 50 cents on a Tuesday afternoon? The dip is irrelevant to the strategy. The dip is merely the market shaking out the weak holders and the impatient traders. You must look at the broad charts. You must see where the weight of money has been placed. You must ascertain the mood of the great financial powers that move this market, the ones who hold stock for months, not minutes. Selective observation means you only pay attention to two things: the overall health of the general condition and the approach of your identified strategic entry level, your pivot point. Everything else is chatter. If you listen to chatter, you lose money. If you listen to the steady, heavy voice of the underlying trend, you stand to profit handsomely. Stop looking at the candle, the immediate, fleeting price action. Look at the architecture of the move. Look at the foundational structure that the market has built over weeks and months. That structure tells the truth. The candle only tells the mood of the moment. The pivot point doctrine is the specific, actionable target of your waiting. A pivot point, as I define it, is not a guess. It is not an arbitrary number pulled from the air. It is a calculated level. It is a price that, if decisively reached and held, signals that the old forces, the dominant buyers or the dominant sellers, are expected to fail entirely, confirming the start of a major sustained movement in the opposite direction, or the continuation of the dominant trend. This is the beauty of the system. You do not watch the market continuously, hoping for a sign. You watch the market until the pivot point is hit, And then you watch the market to see what happens precisely at that pivot point. The time you spend watching the screen is therefore cut down to only the critical moments. You remove the necessity of constant supervision. If a stock is trading at 50, and your research shows that 55 is the breakout point, the pivot that confirms the new advance, why waste your energy watching the stock fluctuate between 50 and 52? That movement is meaningless noise. Your energy should be conserved, your judgment kept cool until 55 is in play. When the stock approaches 55, that is when you must be present. That is when your discipline is tested. That is when you transition from waiting to executing. The pivot point forces discipline. It removes the temptation to enter too early. It provides a clear objective line in the sand. If the price does not clear the pivot, the condition for entry has not been met. You have wasted nothing but time, and time is cheap compared to capital. When you master this, you realize the market is not a continuous performance. It is a series of critical, isolated events separated by long, necessary periods of quiet observation. Wait for the event. Ignore the interim quiet. Confirmation is not a suggestion. It is proof. This distinction is the graveyard of countless speculators. Many men mistake anticipation for confirmation. They see the price moving toward their pivot point, and they feel certain it must clear it, so they jump the gun. They enter early, hoping to save a small fractional amount on the price. They are greedy for a cheap entry, and they pay the highest price possible for that cheapness, the loss of certainty. True confirmation is not just the price touching the pivot point. It is when the stock penetrates that level decisively and holds the move. It is the follow-through. The market must validate your strategic thesis. The price must tell you clearly and loudly that the weight of money is now fully committed to the direction you have hypothesized. If the stock touches 55, then immediately drops back to 54, that is not confirmation. That is a failed probe. That is the market telling you that the resistance at 55 is still powerful. I famously refused to chase a stock that was acting queerly. What did I mean by that? I meant that if I expected a powerful move after a confirmation signal, and the stock merely drifted sideways or struggled or failed to clear the level decisively, I would disregard the whole setup. A stock that is ready to run does not dally. A stock that has truly overcome major resistance acts with authority and vigor. Wait until the market tells you, I am ready. Do not try to guess what the market is about to do. React only to what the market has already done. Confirmation is the receipt of purchase for your certainty. Never trade without that receipt. It is only when the confirmation is undeniable that the speculation ceases to be a gamble and becomes a calculated probability. The rule of initial proof applies the moment your order is filled. Once you have initiated a trade based upon what you believed was sound confirmation, the market owes you something critical: immediate proof that your assessment was correct. This is a rule I developed through harsh trial and error. If you buy a stock at 55 anticipating a strong run, the stock should move immediately in your favor. It should proceed to 55 and a quarter, 55 and a half, 56. It should demonstrate forward momentum. If you enter and the stock drifts sideways, moving back toward 54.90, then 54.80, then 54.50, even if it has not yet hit your stop-loss limit, you must recognize the fundamental truth. The confirmation was false, or your timing was premature. The trade is acting wrong. A trade that is going to be profitable starts proving itself profitable almost instantly. The market does not waste time in confirming a true breakout. This selective observation after entry is just as crucial as observation before entry. If the stock does not act right, cut it immediately. Do not hesitate out of hope. Do not hold it in expectation that it will eventually come back to prove you right. The initial action is the telltale sign. It reveals the underlying health of the movement. If the movement is sluggish, it means the powerful forces you assumed were present were either late or non-existent. A small loss taken immediately to correct a failed confirmation is merely a maintenance fee on your speculation business. A large loss taken because you waited for the stock to validate your ego is fatal. Be ruthless with your wrong trades. The market is objective. Your reaction must be equally objective. If the stock refuses to demonstrate immediate forward motion, the entry was faulty. Liquidate and wait for the next, clearer confirmation. We must discuss the high cost of cheap entries. This is where psychological frailty directly undermines strategic execution. Impatience combined with a false sense of cleverness leads speculators to seek cheap entries. They identify the confirmation level at 55. But they tell themselves, I am smart. I will buy it at 54.5. I will save 50 cents and get a better start. This impulse is catastrophic. It is attempting to substitute your personal anticipation for the objective proof provided by the market. By buying slightly below the confirmation level, you achieve a negligible price reduction. 50 cents is nothing in a major movement that should run 10 or 20 points, but you sacrifice the statistical certainty of confirmation. You massively increase your risk exposure without compensation. If you buy at 54.50 and the stock fails to reach 55 and reverses, you're caught in a bad position, nursing a loss, having violated your own strategic rules. If you had waited for 55 confirmation, you would have avoided the trade entirely. You must pay the premium for proof. Confirmation is your insurance policy. When the stock clears the critical level, it validates your entire thesis. It tells you that the market forces are now aligned. If you refuse to wait for that validation simply to save a fraction of a point, you are trading certainty for trivial savings. A speculator's capital is his greatest asset. His certainty is his second. Why would you compromise your certainty for a few pennies? The true entry point is the pivot point. After. It has been cleared and held. If you miss the entire move because you were haggling over the price just below the critical confirmation level, then you have failed the most basic test of discipline. You must buy where the market tells you the stock is going up, not where you hope it might be cheap. True discipline is achieved through disengagement. This is the paradox of successful trading. Many men think discipline means sitting rigidly at their desk, constantly fighting the urge to interfere with their trades. This is exhausting and ultimately unsustainable. It is relying on sheer willpower, which is a limited resource. True discipline is structuring your plan so the urges don't matter. Once the analysis is complete, once the pivot point is hit, and once the trade is executed, the essential work is done. The stop loss is placed. The objective targets are calculated. What purpose is served by watching the security fluctuate hour after hour? Step away. The market does not require your supervision. Your continuous observation serves only to encourage you to override your carefully planned entry and exit rules. When you watch every small drop, fear tempts you to sell too soon. When you watch every small rally, greed tempts you to raise your stop or increase your position size recklessly. The purpose of a sound strategic plan is to remove emotion from the execution phase. If you constantly watch the tape, you reintroduce emotion. I learned to put my position on, ensure the stop was placed, and then leave the office entirely. I would go home. I would walk. I would distract myself with other matters. The trade, once initiated, must be allowed to breathe. It must be given the necessary room to move and prove itself, or fail according to the rules of the market, unmolested by the nervous interference of the speculator. You did the rigorous work of planning. Now trust the plan. Disengage your emotions. Disengage your eyesight. Your presence at the ticker is a liability to your discipline, not an asset. You must accept the inevitability of accepting missed opportunities. This is perhaps the greatest psychological barrier a speculator must overcome. By waiting strictly for high probability confirmation signals, by adhering solely to your planned pivot points, you will inevitably miss profitable, fast-moving trades that never gave a clear, established signal. You will see men brag about catching a 6-point move in 2 hours, a move you ignored because the stock failed to clear the strategic confirmation level. You must accept this cost. It is the cost of capital preservation. The goal of speculation is not to catch every fish in the sea. The goal is to catch the largest, most predictable fish with the least amount of risk exposure. Those fast, erratic moves that jump away without confirmation are often treacherous. They lure men in, and then they reverse just as quickly, leaving the impatient speculator nursing a significant loss. Livermore, Livingston, understood that the true foundation of a fortune is not built on quick, risky dashes. It is built on catching the big, slow, confirmed moves that follow the general trend. These moves are not spectacular. They are heavy, they are sustained, they are often boring. But they are mathematically sound, and they are where the real money is made. If you chase every movement you see, you are acting as a gambler. If you wait for the confirmed setup, you are acting as a businessman engaged in probabilities. Let the quick profits go. Do not mourn them. Focus your energy on ensuring you do not miss the one great confirmed movement that validates the underlying general condition. The missed opportunities are the psychological price you pay for not losing your capital. It is a cheap price indeed. The real work of speculation is planning, not execution. If you spend all day watching the tape, you are focused on the least profitable part of the process, the execution. Execution should be automatic. It should be unemotional. It should be quick, mechanical, and based on predefined triggers. Your true effort, your intellectual energy, must be focused entirely on preparation. This preparation involves several distinct, time-consuming tasks carried out while the market is closed or while the market is trading far from your strategic points. You must analyze the general condition of the entire market. Is capital freely moving? Is there distribution or accumulation happening across the sectors? Is the mood of the controlling financial forces optimistic or fearful? This is the foundation. Then you must identify the strategic pivot points in your specific securities. You must calculate where the major resistances lie and what price level confirms the breaking of those resistances. You must plan the trade before the market opens. The entry price, the stop-loss price, the objective price, and the precise signals that invalidate your thesis. Stop spending hours watching the screen, which is the equivalent of watching paint dry, only more stressful. Spend those hours studying the structure of the charts, reading the reports, and verifying the soundness of the underlying trade idea. That structural study is the true work of the successful speculator. It is the intellectual labor that earns the immense profit. The act of placing the order is merely the final, necessary clerical step. When you focus on planning, you remove the need for constant observation. You are simply waiting for your plan to align with the market reality. The less time you spend watching the screen, the more profitable your actual market behavior will become. Stop watching every trade. Your job is not to be a spectator enthralled by the daily momentary drama of the ticker tape. Your job is to be a strategist. Your task is to remain cool, detached, and observant only of those moments that truly matter. Learn to watch for the one trade that matters, the major movement that is backed by undeniable confirmation and the clear, heavy weight of the general market. That is how the big money is made. In the silence, in the methodical planning, and in the unwavering commitment to waiting for confirmation. Do not allow the market to confuse you with its constant chatter. Master the art of selective observation, and you will master the market. That is the only road to sustained success.